All right, so we're diving into some serious investing wisdom today. You ready for this?
Oh, absolutely. Can't wait to dig into this one.
You and we're going deep into Benjamin Graham's The Intelligent Investor. I mean, this book, it's basically the Bible, right, of value investing.
Yeah, that's the one. Still holds up today.
Totally. And it's incredible how relevant Graham's ideas still are, even with, all the tech and the crazy market we have going on.
It really is. It's almost like he could see the future of investing or something.
Yeah, exactly. So no matter where you are with, your investments, this deep dive, there's something here for everyone, I think.
Totally agree.
Now, Graham, he starts right off the bat, and he gives us this definition of an intelligent investor. I'm just going to quote him here, okay?
Sure.
An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. So much in there, right?
Oh, for sure.
Yeah.
It sounds simple on the surface, but there's a lot to unpack. It's like he's laying out this whole philosophy, not just a strategy.
Right.
He's saying, hey, intelligent investing, it's about really researching, about protecting what you've earned, right?
Yeah.
And not falling for those unrealistic, crazy high returns that everyone's chasing.
It's about the long game, right? Not getting swept up in the hype.
Exactly.
And it's funny because even really smart people, they can fall for market mania. Remember that story about Sir Isaac Newton losing his fortune in the South Sea bubble?
Oh yeah.
It just goes to show you even brilliant minds, they can get caught up.
Definitely. It shows how much psychology is involved,
Yeah.
right? And how emotions can just mess up our decisions.
Absolutely.
And that's a big reason why Graham, he was so skeptical of trying to, time the market, trying to predict those short-term ups and downs.
Right.
He thought it was a fool's errand, really.
Yeah.
And this is where, his famous analogy comes in, Mr. Market.
Oh, Mr. Market. Yeah, I always picture him as this kind of unpredictable character, swinging between super happy and totally depressed.
Oh, that's perfect.
Yeah.
Yeah. Imagine him, this business partner. He's constantly bugging you to buy or sell your investments. And the prices, they're all over the place, right?
Oh, yeah.
Totally driven by emotion, no logic. Some days he's super optimistic, offering you these inflated prices. And then other days, he's like, oh, the world's ending, practically begging you to sell at a loss.
So if Mr. Market is this unpredictable, how do we deal with him as intelligent investors? Because I think I would just be tempted to kind of ride that roller coaster, buy low and sell high.
Yeah, that's exactly the trap that Graham warns about.
Yeah.
So instead of reacting to his mood swings, you focus on what your holdings are actually worth, the intrinsic value.
Okay.
Like what are the businesses that you're invested in? What are they really worth based on, fundamentals? Don't let Mr. Market make your decisions for you.
You're in control.
So we have to come up with our own assessment of what the business is worth, right? Not just rely on what the market is telling us at any given time.
Yeah, exactly.
Now when it comes to actually doing this, right, putting this into practice, Graham, he outlines these two main approaches. We have the defensive investor and we have the enterprising investor. Can you kind of break down the big difference between those two?
Yeah, absolutely. So the defensive investor, this is someone who's really prioritizing stability and simplicity in their portfolio. They don't want to spend hours and hours poring over financial statements, trying to be smarter than the market. They just want a good, solid approach that doesn't need constant attention.
Right. So for our listener, right, who's out there, maybe they're busy, they've got a career, they've got a family, they've got other commitments. This defensive approach, that could be a good fit for them, right?
Yeah, could be. For this type of investor, Graham recommends a balanced portfolio, at least 25% in bonds and no more than 75% in stocks.
Now, some of you might be thinking, why that split? Well, Graham, he believed that bonds, they give you a cushion, right? They're kind of protecting you against the volatility of the market. And remember, he was all about minimizing risk, not losing your money.
Exactly, yeah. And within that bond allocation, he suggests sticking with high-quality bonds.
Yeah.
Like those issued by the U.S. government or very financially sound companies.
Right.
So you're minimizing the risk of default. When a company or the government can't pay back its debts.
Okay. So for the stock portion, does Graham recommend picking individual stocks or does he have a different approach?
For the defensive investor, he really stresses diversification, sticking with large, well-established companies, ones with with a proven track record of profitability and are just, stability.
Right.
He wasn't a fan of risky bets or trying to find, the next big thing.
This part about sticking with those large, stable companies, it makes me think about index funds. It's like Graham's advice is almost more relevant today because now you can get that broad diversification, right? Hundreds, even thousands of companies in one single low-cost investment.
Absolutely. Index funds, they've really changed the game for the defensive investor.
Yeah.
They make it so much easier to follow Graham's principles. you know? Diversification and investing for the long term. And then another great thing, usually the fees are really low compared to those actively managed funds.
So even though the investing world has changed like a lot since Graham's time, his core wisdom for that defensive investor, it's still so relevant.
Oh, for sure, definitely.
But what about the people who they want to be a little more hands-on with their investments? That's where the enterprising investor comes in, right?
Yeah, exactly. Yeah, the enterprising investor, they're willing to put in the work, really dig into the research and maybe take on some more concentrated positions.
Right.
They're not afraid to kind of stray from the usual index fund approach, if they think they can find those hidden gems, those undervalued opportunities.
So they're kind of like the detectives, right, of the investing world, like searching for those companies that maybe everyone else is overlooking, but I imagine that takes a lot of time, a lot of knowledge, maybe even a higher risk tolerance.
Oh, definitely.
What are some of the key strategies that Graham recommends for these enterprising investors?
Well, one thing he was really clear about was avoiding those new issues, the IPOs, especially during those bull markets.
Okay.
He saw them as often overpriced and likely to just plummet. Once the hype died down, he actually compared them to saplings, like newly planted trees.
Oh.
They look promising, but
Right.
but they often just wilt under the pressure, right, of those market expectations.
That's such a good analogy, yeah. Because it is so tempting, to get caught up in the excitement, right, when there's a hot new IPO. But Graham's telling us, hey, be careful, remember that long-term value it comes from those solid fundamentals, not hype.
Yeah, exactly.
So if we're not chasing those IPOs, then what should an enterprising investor be looking for?
Well, Graham, he really believed in seeking out what he called bargain issues. So companies that were trading for less than what they were really worth.
Yeah.
Their intrinsic value.
Okay.
He suggested looking for companies that had, strong financials, but whose stock price it might be kind of down temporarily because of market sentiment or maybe some short-term challenges that they were facing.
So we're looking for like the diamonds in the rough. Those companies
Yeah.
with that strong underlying value, right? That maybe the market's just mispricing. Can you give us an example of what that might look like today?
Sure. So imagine a company that has, a solid track record of earnings, strong balance sheet, but their stock price has taken a hit maybe because of an industry downturn or some bad news in the headlines.
Right.
But if their long-term prospects are still good, then an enterprising investor, they might see this as a chance to buy in.
Yeah.
At a discount.
I see. So it's about being like contrarian, thinking independently, not being afraid to go against the crowd. And this reminds me of that case study that Graham did on Chrysler's stock price between 1952 and 1970.
Oh yeah.
He showed how an enterprising investor, they could have made a lot of money by buying when the price was low and then selling when it went back up.
Yeah, that's a great example. It really shows the potential rewards, but also the challenges of investing in those cyclical companies.
Right.
Chrysler's stock price, it was all over the place during that time.
Yeah.
And it took a lot of patience and really understanding the company's fundamentals to take advantage of those swings.
So you really got to do your research, right?
Oh, yeah.
And do that analysis. Now I know Graham was pretty cautious about growth stocks, particularly for the average investor.
Mm-hmm.
Why was that? Weren't growth stocks like the big thing back then, just like they are today?
Well, yeah, some growth stocks they can generate awesome returns.
Yeah.
But Graham he thought they were just inherently more unpredictable and risky.
Okay.
Especially when you buy them at those really high prices.
Right.
He argued that it's really tough to predict which companies are going going to keep growing over the long term.
Yeah, it's like trying to catch lightning in a bottle. There's always that excitement of maybe finding the next Amazon or Tesla.
Yeah.
But it's easier said than done.
Yeah,
right?
definitely. He warned against just assuming that past performance it's going to continue. He used the example of Texas Instruments. It was a really popular growth stock in the 1960s, and then it ultimately collapsed.
Oh wow!
And he used that to show the dangers of just assuming that high growth is going to go on forever.
Yeah, it's a good reminder that even those companies that seem like they can't miss, they can stumble.
Yeah.
So it sounds like Graham is saying, hey, take a more grounded approach to investing. Focus on value and those fundamentals.
Yeah.
Rather than getting caught up in the hype. Now speaking of fundamentals, Graham was really big on financial analysis, right? He really believed in understanding a company's financial statements before making any investment decision.
Oh, absolutely. Yeah. He laid out all these key metrics to analyze. So for bonds, he said it was important to look at the earnings coverage of fixed charges.
Okay.
Which is basically just measuring how well a company can meet its debt obligations.
So making sure they've got enough earnings to pay their interest, right?
Exactly.
What about for stocks? What were some of the key things he looked at?
For stocks,
Yeah.
he focused on profitability, stability, and the growth of earnings. He wanted to see those earnings be consistent, over time, not just a one-time bump. He was also interested in a company's financial strength. So looking at things like their debt levels and working capital.
I remember he had this really interesting example in the book where he compared 4 different companies: Emerson Electric, Emory Air Freight, Emhart Core, and LTRA.
Yeah.
And it was like a practical way to see how you apply these metrics in real life.
Yeah, Graham, he wasn't just about the theory. He wanted to show investors how to actually use these principles.
Yeah.
And what's really interesting is even though he wrote this book like decades ago, those metrics are still used by investors today.
Right.
Of course, there's new metrics and tools available now, but Graham's core ideas about financial analysis, they're still foundational.
It really shows you how timeless his approach is. So whether you're a defensive investor, right, looking for that stability, or an enterprising investor hunting for those undervalued opportunities,
Right.
understanding the financial health of a company, it's just crucial.
It is, yeah. It's not about just blindly following formulas, or chasing trends. It's about doing your homework, right?
Right.
Understanding the businesses that you're putting your money into.
Right.
And making those smart decisions based on solid analysis and a long-term view.
And remembering that Mr. Market, he's always going to be there, right?
Yeah.
Offering us deals and trying to tempt us to stray from our strategy. Now speaking of Mr. Market and how we think about value, Graham, he left us with this really interesting question. He asks, if the 1964 price level is not too high, how could we say that any price level is too high?
It makes you think, doesn't it? He's really pushing us to really think about market valuations and not just accept what the market is telling us.
Right.
Just because a price exists, it doesn't mean it's rational or justified.
So just because a stock is trading at a certain price, it doesn't mean it's actually worth that much. We have to have our own way of figuring out, what something is worth, separate from how the market is feeling.
Right. And that's a key part of being an intelligent investor. Whether you're more, defensive or enterprising, it's about developing your own judgment, doing your own research, and not being swayed by the market just changing its mind all the time.
So as we wrap up this deep dive into the intelligent investor, what would you say is the one key message that you hope our listeners will take away from Graham's wisdom?
I think it's this. Investing, it's not about gambling or getting rich quick. It's about being a business owner, really understanding the value of those businesses you own and being patient, letting that value grow over time.
And remembering that Mr. Market, he's always there offering us deals, those temptations.
Oh, yeah.
But we have the power to choose, do we play his game or do we stick with our own, well thought out strategy?
Well said. Graham's principles, they're they're as relevant today as they were all those years ago.
Mr. Market, he's always there offering us deals, those temptations.
Oh, yeah.
But we have the power to choose, do we play his game or do we stick with our own, well thought out strategy?
Well said. Graham's principles, they're as relevant today as they were all those years ago.
Yeah.
And anyone can use them to navigate the market.
Yeah.
Right. And build that solid foundation for their financial success.
So there you have it, a deep dive into the mind of Benjamin Graham, the father of value investing. I hope you enjoyed exploring this world with us. It's easy to get, caught up in all the ups and downs of the market,
Oh,
right?
that's for sure.
And kind of forget about the bigger picture,
Yeah.
Graham. He really gives us that grounding,
Mhm.
that voice of reason reminding us, hey, focus on value, focus on analysis, and think long term.
Yeah. He really encourages us to think for ourselves,
Right.
Question those assumptions and not get swept away by all the hype or the fear. In today's world, there's so much information. So that's a really important skill.
Absolutely. It's like he's giving us these tools to be more informed and more confident as investors, right? So instead of feeling overwhelmed by all the noise, we can look at the market and have that clarity and purpose.
Definitely.
Now, before we wrap up, I wanted to mention one more thing that really struck me while I was reading The Intelligent Investor, Graham. He talks about having a margin of safety with our investments.
Oh yeah. That's a key concept.
What does that mean?
So basically, it means buying a stock for a lot less than what you think it's really worth its intrinsic value.
Right.
It's like having this built-in protection, to protect you from those times when maybe your analysis was a little off.
Yeah.
Or if something unexpected happens that impacts the company.
So instead of trying to buy a stock for what we think it's worth, we're trying to get it for less, right?
Yeah.
kind of gives us that buffer zone.
Exactly. Like a safety net.
Yeah.
In case things don't go exactly as planned.
Right. And that margin of safety, I guess it could be different, right? Depending on the company, the industry, and just the overall market.
Oh, definitely, yeah.
But the idea is the same, right? Don't overpay, even for a really great company.
Don't overpay, yeah.
Thinking about this idea of margin of safety, it seems like it could apply to other parts of life too, not just investing.
Oh, it's
like being careful, not taking big risks unless you have to, and always having a backup plan.
Yeah, that's a great point. I think Graham's wisdom it goes beyond just finance.
Yeah.
He was all about being rational, being disciplined, thinking for yourself, and that can apply to making decisions in all areas of life.
Absolutely. So as we wrap up this deep dive into the intelligent investor, I'm curious, what would you say to someone who's just starting out with investing?
Yeah.
What's the most important piece of advice you would give them?
I would say start by reading The Intelligent Investor.
Yeah.
It's such a foundational book. It can give you a really good framework for how to think about the market.
Right.
And beyond that, I'd say be patient, do your research, and never stop learning.
Those are great pieces of advice. Investing, it's a journey, right? It's not a destination. It's about constantly learning, adapting to new information, and just always trying to make those smart decisions.
And remembering that Mr. Market, he's going to be there the whole time, right?
Oh, he is.
Trying to tempt us with those emotional swings.
Right.
We get to choose how we react to them.
Well said. Well, I think we've covered a lot today.
We have.
And I hope our listeners is leaving with some really valuable insights from Benjamin Graham.
Me too. His wisdom, it's timeless.
Yeah, it is.
And it can help anyone become a better, smarter investor.
So on that note, we'll wrap up this deep dive. We hope you enjoyed exploring the world of value investing with us. Until next time, happy investing.